It's not at all uncommon for different duration Treasury yields to rise and fall at different speeds, creating varied slopes of the yield curve to reflect market conditions. Much more rare is when different duration yields move in entirely opposite directions. Well, in recent weeks, 30-year Treasury yields have risen while shorter-term yields have fallen, a pattern last seen in 2001. This shift is driven by a couple interesting factors. First, the Federal Reserve has cut short-term interest rates by 100 basis points since September of 2024, lowering short-end yields, and they seem bent on continuing easing, potentially as much as 50 basis points in 2025, according to the CME FedWatch tool. However, longer-term yields have moved higher, with 30-year Treasuries recently topping 5%, a level not seen since 2007. Why is this happening? Well, investors seem to be demanding higher yields to hold longer-dated bonds due to rising concerns about the U.S. fiscal policy, ballooning federal debt, and the potential for higher inflation in the future. There's also the uncertainty about how much more debt the government will need to issue and whether there will be enough demand to absorb it without further increases in yields. All this happening while falling short-term yields reflect expectations for more Fed rate cuts, and perhaps these are tied to some economic uncertainty due to recent trade conflicts and tariff talk.